Everyone, welcome to another session on earnings management. So in this video series, we will be looking at accrual based earnings management. So chapter 1, we will be looking at definitions. So first of all, let's start with earnings management. So this is just a pre-idea or a preconception of what's earnings management. So earnings management refers to a company's net profit, net income. So basically whatever income remaining after all the deduction is known as net income. It can be for the physical quarter, half a year or yearly. So in terms of earnings management is the use of accounting techniques to produce financial outcomes or prepare financial statement that has a positive view, meaning actually the company or the organization made a loss or a negative outcome which is not expected during a specific period, but however the management of the company decided to manipulate or window dress it or dressing the financial statement using accounting techniques to give a positive review. So this is mainly to achieve investors, increase stock prices, achieve executive bonuses, or even to get financial institution to provide them more funds in terms of loans or other financial monetary benefits in order to run the company. And I have put it as Sarbanes-Oxley Act of 22 to get a better idea of what happened during the past years. So let's move on to the next slide. So why do management do it? So some of them, this is where the theory, agency theory comes into play. So some might do it because their personal financial benefits are tied to the outcomes of the financial statement. If not, there are external pressures from shareholders, the market, to increase the price up. Okay. And apart from that, then what is accrual based real earnings management? So I have another series called real earnings management. Now here is accrual based earnings management is where managers use accounting policies from a set of generally accepted accounting policies to achieve earnings objective. But please do keep in mind, these practices can differ to region, accounting policies and practices and standards, because there is United States generally accepted accounting practices and there is United Kingdom's generally accepted accounting practices and IFRS. So these even from region to region. So the West and the East will be using different accounting setup principles. The Indian region will be using a separate practices. Even Australia, the Australian and the New Zealand region will be using a separate practices, and their governing bodies are separate. So therefore, it is important to know, okay, what is accrual based earnings management and real earnings management. So real earnings management occurs when managers undertake actions that change the timing or structuring of operations. Now, in terms of manipulating, accrual based is a little bit comparatively easier to real earnings management. At the same time, when detecting accrual based to real earnings, accrual based is a little bit less complex compared to real earnings management. Now, in this series, we will be looking at one of the model, or we are going to study deep into one of the models. There are several models. So I have listed 6 popular models: D'Angelo model, Healy's model, Jones model, modified Jones model, and industry model and cross-sectional Jones model. But out of all these models, the modified Jones model is the prominent and applied by various scholars, students, etc., to identify the accrual based earnings management. So in this series, we will be looking at modified Jones model. what does it comprise, and how are we going to solve it, like how to calculate that complex model. So now this is just a brief explanation, because Dishaw, Solon, and Sweeney in 1995, they demonstrated that, okay, out of all the models, Jones model, modified Jones model, has generated a lower power of earnings management, and the test levels. So the significance when it comes to statistical testing showed that, okay, modified Jones model is far more better and comprehensive compared to the other models, and they showed provides most powerful test of earnings management. So this is your research grounding if you're a research student, to show, okay, why am I doing modified Jones model, and this is the reason. And these are the references, all the research papers if you need to identify in this slide, and you can go through it and get a better idea and understanding of how this has happened. So in the next slide, now the next series, we will be looking at the components of modified Jones model, and later on we will be discussing how to calculate it using an Excel series. Thank you.